What properties do you best recommend for your clients that want to purchase an SMSF? Does yield become much more important than compared to, say, buying in your personal name? Good question, JL. So it really depends on where you are at, in my opinion. Again, this is not financial advice. In my opinion, the common mistake people make is when they buy a property in self-managed super fund is they rush too early in because some accountant, and I don't know why, I've spoken to many financial planners and accountants, and no one can actually tell me the answer. And no one, and when I've run the modeling, they're wrong. Not all wrong, sure, I should say, but so it's just almost like you go to some accountants, they'll tell you that the minimum you need to buy a property in your self-managed super fund is $200,000. There actually technically is no minimum. The minimum is zero. As long as you can afford to service the property, you don't technically need to have a what is it called? A liquidity buffer. That's just good practice. So again, there's no actual minimum. But to your question, you should always be focused on leverage and capital growth. You can't actually do anything with the cash flow from your self-managed super fund until you retire. So if that property is making money for you, fantastic, that's great, but you're not going to be able to access it to retire till retirement. So your sole focus should be to get assets that grow and utilize the leverage to then, because you've got such a tax-friendly environment in super and you can't tap into the equity. So again, the mistake people make in their super fund is that they think they're going to buy these assets and hold on to them forever. So they buy a $500,000 asset, it goes up to $1 million. They can't tap into that equity. They then just focus their cash flow on paying down the asset, which in turn reduces their leverage, which in turn reduces their rate of return on their investment, where the reality is you actually should be looking to buy higher leveraged assets. Obviously, you want to get to the point where now, whether that's 70% or an 80% LVR, that's going to be dependent on your situation and your contributions, etc. But most people would get better returns if they got a 70 to 80% loan on a residential asset, held on to it for say 4 to 8 years, sold it off for profit, and then use that profit because you're only going to pay essentially 10% capital gains tax on that property in super, and then buy multiple assets and continue to do that. It only really makes sense, in my opinion, when I've done my own modeling, for someone to buy a higher cash flow producing asset in super when they want to focus on retirement and having a cash flow stream. During your working years, you can't access the cash flow anyway. It's unleveraged. Leverage is the most important thing as well.